We're in an energy commodity supercycle. The demand is going to be 900 this year. And if the war is over, it could be 1.1, 1.2. The industry can't even produce a third of that, which means the only way to ration supply is higher prices. The price of oil has gone from 67 to 88 to 89 at the high today. And so big moves there. And the basic issue is peace or war. The Americans have sent dozens of refueling tankers to Israel to be ready to help if the war expands.
Looking at the oil and gas landscape through the lens of an investor now, where are you seeing the most opportunity?
There's still a lot of opportunity there, and if the prices go up, as I said, I expect $90 next year for the average price, but it could be 100, 110, 120.
Josef Schachter, it is great to have you back on Commodity Culture, and a very timely interview, I think, because what a roller coaster ride the oil market has been on since the start of the war in Iran. The last time you were on the show was actually February 22nd, less than a week before the conflict officially kicked off. You said in that interview, oil's going to $100. You were right. Of course, we've seen it correct since then, but it appears like it could be headed back to triple digits as Iran and the Houthis move to potentially close the Strait of Bab el-Mandab, and the war in the Middle East continues to ramp up. Doesn't seem to be an end in sight at the moment. What are your thoughts on the recent price action and where you see the oil market headed for the rest of 2026?
Well, we had that big run up to that $119 when the war started in March. It backed off to $67 in early July. In early July, as you know, on peace talks going on, and then that fell apart. And Iran's hawks took over again. The IRGC took over again, and the price of oil has gone from 67 to 88 to 89 at the high today. And so big moves there. And the basic issue is peace or war. And, if Secretary of State Rubio today said that Iran is not serious about talking, Pakistan and Qatar are trying to get the moderates to gain control or gain some power internally in Tehran, but that's not seeming to happen. The IRGC seems to think like the North Vietnamese. The longer this lasts, we win. The Americans can't stay. They're running out of missiles. The Pentagon's even admitted that certain munitions are running out of stock. And so the longer they play this out, and now they've got the Houthis rearmed, and they're now, talking about blockading Saudi Arabia's, Yanbu facilities, attacking ships in the Red Sea. That means two straits, become non-ability to travel and bring crude to Asia. Asia's the big loser here. That's why prices in Asia are high. Diesel prices are high. All refined products are high. Refinery margins are at record highs. So it's quite the situation. And now the question is, the attack on Jordan, brings another country into play here. And the Iranians, seem to get their proxies ready to attack more, bring in Jordan. Do they bring in Israel again, which just widens the war? So the hawks are in control right now. The Americans have sent dozens of refueling tankers to Israel to be ready to help if the war expands. They've sent more fighter jets in, more naval assets. So it could go either way. Right now the hawks are winning, and if the shooting war expands from the proportionality, you hit me twice, I'll hit you twice. You hit me 80 times, I'll hit you 80 times. That seems to be what's going on. But if it expands and goes, disproportionately, then the big problem is the desalination plants. Not only are they attacking bridges and pipelines and refineries and the energy infrastructure, and also commercial and buildings, but the desalination plants are very critical because they don't have water of their own. Kuwait is the most vulnerable. They have 8 of them on the Persian Gulf Coast, if those get taken out, they have only 5 days of supply. So the water is becoming the critical side for both sides of both Iran has shortages of water, and then the Western Persian Gulf guys have the same problem. So I think the next 2 weeks will tell you if we're going to be 150 or we're going below 70, and which call. I sure hope it's not the Hawks winning. I sure hope rational behavior becomes the norm, because if you don't have water for your population, that should wake you up to the fact that this war, nobody's going to win.
As we're speaking today, oil is around $86 a barrel. How much of this recent price rise is purely due to the conflict in the Middle East? And how much is simply a reflection of supply demand imbalances in the market? And if we do see peace finally materialize, as you said, you think that oil would take a hit in the aftermath, potentially down to that $70 range? Could it even go lower in that scenario?
Let's start with the war situation. Yes, I believe there's a $20 war premium in there right now. We had, going back a few weeks ago, almost no war premium because there was peace talks going on, and there was optimism that they were going to be progressive, and that that's why we saw $66 a barrel. Remember, the industry needs mid 60s to break even. If you go to the Federal Reserve of Dallas, they put in a lot of nice charts about all the basins and what the break evens are. So that's really where you are, is that break even situation in mid 60s. And we got back down there. Remember, there's a lot of floating storage out there. Iran, during those peace talks, shipped a lot of oil out. Russia has shadow fleets. There's a lot of oil on the water. So that oil was driving the price down during those peace talks, because everybody said, okay, the straits are going to open, insurance rates will come down. Not only will ships load up and leave, but ships will also come back and reload. That's the big question, which was at the market's view at the time. Now, of course, the strait is closed. Both straits are closed. No ships are going in, and no ships are getting out. And that's why we have this price spike. Now, the question is, if it becomes a broader war, then of course prices will go higher. In terms of supply demand, I think with the water, the ships on water with capacity, I think right now the big problem is refined product. So in Asia, because they're the ones that lose out from both straits being closed, because that's the southern route that you take to go through the Straits of Malacca to go to Japan and South Korea and China and India, and they can't get that oil. And so if they're not getting that oil, the refineries are, of course, with the oil that does come in, they're going to go to the most profitable product. And you can't, blame them. That's what they're going to do. And refining margins are at the highest they've ever been. And so that's why you're seeing diesel and other jet fuel and other prices. And of course, a lot of the airlines right away plug on an extra fuel surcharge so that they can recover those costs. I think one of the U.S. airlines, when they reported their initial Q2, says it cost them $6 billion in the quarter, higher fuel prices that weren't hedged. So I think that, the supply and demand is not the problem. It's the war. It's the shortages in Asia. Europe, if the Houthis attack the Saudi facilities or stop or blockades the strait, then oil can go through the Suez Canal, and that oil could go to Europe. So Europe may not be in as bad a shape as Asia if the Houthis do their damage and listen to Iran and expand the war, further than just the Arabian Gulf.
Well, assuming this war does continue on its current trajectory, which seems to be not stopping anytime soon, and we do see the Strait of Bab el-Mandab also completely closed off by the Houthis, what would the implications be for the global economy, and how much damage could that do to your everyday consumer around the world? Because we've heard a lot since this war kicked off, since the Strait of Hormuz was initially closed, that it could be catastrophic. We could see food shortages. We could see skyrocketing gas prices, which they have gone up in a lot of places, but we have yet to see that maximum catastrophe that has been forecast by a lot of people. Is that just because this is a kind of a trailing effect, that it takes some time to fully have an impact on the global economy? And like I said, assuming this continues on, could this get much worse?
Again, the longer this continues, the worse it gets. Remember, sulfur coming out of the Gulf is important for the fertilizer industry. Just look at wheat prices. They've taken off like crazy. Just, if you put a chart up of wheat, you'll see there's the perfect example. Of course, Ukraine and Russia are the breadbasket for Europe. They can't move it because they're attacking each other. And of course, fertilizer prices have gone up. So I think that's really a point for the market to worry about. The worst case scenarios are the longer it lasts, the wider it expands, Could we see a price over the US 147 that we saw in July of 2008? In the worst case scenario, yes, but it won't be for a very long time because it will cause a catastrophic and severe economic slowdown, recession for sure, something more severe than that possible. Because this is not something that central banks can say we're going to lower rates or we're going to give money to the banks like they did during the financial crisis. This is nothing that central banks can react to. Could you see the straits reopen? Yeah, a totally American walk away from the Middle East and saying, Iran, you win, which means all of their friends on the Western Gulf are not going to be really happy with the United States, and definitely they don't want to be under the thumb of Iran. So it's a quagmire that doesn't have an easy solution. The only way you could maybe see something in the near term is this water situation. If Iran runs out of water and its people go to the streets and the IRGC and the military decide and the police they're not going to shoot their people because of water. It's not like they're protesting the regime; they're protesting the fact that they can't survive. You may not be able to, you may be able to survive with not so much food for on half rations or whatever, but you definitely can't survive without water. And to me, the water issue is really the one, because the attacks on desalination plants against Kuwait that we've seen, Bahrain, and of course, the U.S. has done that against Iranian facilities. That to me is really the point of no return, where either it escalates into a massive firefight and massive casualties, or it brings people to the brink and says, okay, this is stupid. Our people are rebelling. They don't have water. How do we solve that problem? And then maybe we come back from the brinkmanship.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. I want to talk about OPEC Plus, and I'm going to read a quote from the Egypt Oil and Gas Group. It says, 7 core members of OPEC Plus have agreed to implement a crude oil production adjustment of 188,000 barrels per day for August 2026, according to a release by the Organization of the Petroleum Exporting Countries, end quote. Now, this is the 5th consecutive monthly increase in production from OPEC member nations. And it should be noted, I believe, perhaps you can correct me if I'm wrong, this is replacing previous production cuts that they had put on the table earlier, and now they're rolling that back. Would love to get some insight there into how significant this is and how OPEC Plus is having an impact on oil markets in general in this time of supply side uncertainty.
Well, what they're talking about is an OPEC quota. So what they're doing is increasing the quota. It has nothing to do with production, especially with the straits being shut. So, you can say I'm going to raise production by 188, but I can't sell anything today. So it's totally an oxy situation where they're trying to say that they're going to do something when they just can't do it. So to me, OPEC really needs the straits to reopen. Countries that are all trying to find alternative routes. Iraq is talking now to Turkey about expanding the pipeline to Ceyhan from Kirkuk from 250,000 to 750,000. You saw the announcement that Chevron and ConocoPhillips are talking to Iraq about building a pipeline through Syria to the coast in Syria to move oil, and maybe even to Jordan to Aqaba. You're seeing, Oman and UAE talking about a pipeline again through the desert so they don't have to worry about the strait. Saudi Arabia did Yanbu. They're talking about even another pipeline to the Red Sea and go north to, through Suez. So everybody's talking about finding alternative solutions. And in, construction time in the Middle East is not so long as it is in North America, where we have to go through environmental and, bird species and First Nations issues like in Canada. They just, through the desert, you just build it. And they can build it very quickly, as we saw that pipeline through Oman. So I think that the reality is that we will not see a physical problem for oil 3 to 5 years from now. It's a question of what happens over the coming months, and that's really the issue of the $150 oil or $65 oil. Do we see them come back to the peace table, or do we see the escalation, which expands it to more countries? And does Saudi Arabia get involved? Does Jordan get involved? Does Israel get involved again? That just would make it so horrible. And here's a big dilemma for Pakistan. If Saudi Arabia gets attacked, they have a mutual defense treaty. And right now, they're the ones who are the mediators with Qatar to get peace. What do? Do they have to, if Saudi Arabia gets attacked, do they send in troops and fighter jets to Saudi Arabia to defend the country and, their missile systems, to defend Saudi Arabia? And of course, that just means any walk to the peace table gets more and more difficult.
Yes, and great insights. And so many people are focusing on the conflict when it comes to the price of oil. But I wonder if perhaps we could strip all of that away. If this conflict didn't exist, how bullish would you be on the oil sector? And over the long-term trajectory, if we look for a 3 to 5 year range, do you see prices going to the upper right of the screen over that time frame? Because we've heard a lot about the fact that there is not enough oil being produced, and the demand is actually rising incrementally, contrary to what the IEA and some other organizations have said. What is your thoughts on just the macro picture right now for the oil business if we remove this conflict entirely from the situation?
People are talking about demand growth, and as you said, the IEA is bearish. The EIA and OPEC is bullish. Just to give you we're talking 800,000 barrels a day of growth, and people saying, well, Asia is going to be down, Europe's going to be down, but the third world is growing, because if you want lithium and nickel and copper and all the things that we need for the transition to data centers and all the grid improvements that are going to need. But just take the U.S. alone. The U.S. is the biggest consuming market, and it's they produce 24 million barrels a day. EIA data just came out this morning, and they consume 20.5. So they have 3.5 million that they have excess, and they exported last week 3.35 million. So they export to the rest of the world the light crudes from Texas, and they import heavier crudes to meet the needs of the refineries in the Gulf Coast and in the Midwest of the United States. The point to make, though, is year to date, year over year versus last year, the EIA shows that the demand is 20.62 million, up from 20.15, up 470,000. So when the world talks about 900,000 of incremental demand, the Americans are half of it. The U.S. is the big player. And so so that's really the key. The third world will be big. I agree. Europe might be down. Asia, other places, some of them might be down. But the big one that everybody argues for the bearish case is that China is, demand is down by 4 or 5 million barrels a day. China is one of the most successful commodity investors ever, and they buy when things are cheap. They don't buy, they just pull away. The Reuters had an article this week showing the storage levels, and at the high it was 1.45 billion. It's now 100 million less because they stopped buying, but that's triple what it was from 2010. So they have been buying and building and building and building. And the fact that they stopped buying right now does not mean final demand internally in China has gone down. Remember, their exports are taking off like crazy. They're maybe and even the consumer in China is starting to show positive growth again. So China is not going to be a negative number. The U.S., I just gave you the numbers, and that's a weekly number we can get from the EIA, real numbers. And to me, that tells you that the demand is going to be 900 this year. And if the war is over, it could be 1.1, 1.2. The basic situation is the industry is not spending enough money to replace those declines. The growth we're going to see is Guyana, offshore Brazil. The U.S. has mentioned the U.S. Numbers today. The production this year from just on crude oil, 13.8 million, up from 13.3, up 525,000 BOEs a day. That's just on oil. Then you take into account the natural gas liquids, 10.2 up from 9.79, up 415. So that's really where the growth is coming, is in the United States particularly. Canada's 100,000. We know, the massive declines occurring in the Persian Gulf. So the industry is going to be okay. And we need to see higher prices for the rest of the world to start spending money. Britain, with the new prime minister, has to say they're going to start drilling in the UK North Sea. Norway's still growing in their production. The basins are the same, and it's the same thing like Mexico. The U.S. Gulf Coast is showing, more production growth from the offshore in the Gulf of America. And yet the Mexican side, because the costs are 50 million or 80 million a well, they don't have the money at Pemex. So they've got to change their rules, allow foreigners to come in and let foreigners make an adequate or attractive rate of return, and they'll spend money. Same thing like Venezuela. They have the capacity because the basin is there geologically. Again, it's money, 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 and rate of return. And if you're not going to get an adequate rate of return, you're not going to do it. So to me, tier 3 wells right now don't make any sense. Nobody's going to, the costs don't make it. If we see $100 oil, then tier 3 becomes tier 2, tier 2 becomes tier 1. The returns are there. And, the industry, when they see prices like today, the 86, 87, they don't make decisions on that. They're still making decisions on $70 oil. And so if the long-term price is 70 and they don't believe the economics are there, they're not going to spend the money. The reason the Permian is coming on with these and Texas is coming on with more is the technology has improved so much. The length of the wells, the multi-legged side of it, the completion techniques. And so the United States is sitting there with some of the best technology in the world. Canada has, similar technology, and our basins are growing for the same reasons. And yes, the basin is more drilled out than it has been in the past, but price can change things. So a tier 3 well can become a tier 1 well at $100 US a barrel. So higher prices are going to be needed globally in the years ahead. I'm using $80 a barrel for 2026. I think I'm going to be low given what we're seeing today and the length of this situation that's going on. I'm using $90 WTI for 2027. And the reason is, and I'm assuming the war ends, but we're going to need to restock the SPRs. Europe's going to have to restock the SPR. The U.S. is going to have to restock. That could be 500,600,000 barrels a day of demand just there. Then if there's 1.1, 1.2 of global demand, the industry can't even produce a third of that, which means the only way to ration supply is higher prices.
Excellent analysis. I want to talk about U.S. production because crude oil production hit a monthly record in April of this year. But at the same time, we're hearing some analysts say that many of the major shale oil fields are in decline, new wells getting more and more expensive to economically bring online. What's your take? Will the U.S. continue to be an energy superpower moving forward, or are you seeing signs that production could be rolling over in the big basins?
Well, there's always depletion. It's just the nature of the beast. You draw oil out, the pressures decline, the production declines. So you've got to spend money drilling more, or you got to find more efficient ways, or you got to drill longer reach wells, or the price has to go up and your tier 2 wells become economic. And then longer term, you get $100 oil, your tier 3 wells become economic. So it's not like they're out of inventory. It's just they're out of low cost, inventory, which is your tier 1 inventory. And if they're using $70 a barrel, they're running out of that. At 80 and 90, your tier 2 becomes economic. And at 100, your tier 3 becomes economic. So is the U.S. basin tired? No. It's just that it's going to need higher prices for the less economic plays to become economic. And yes, the key tier 1 wells today are in their decline. And so that is a fact of life. So that is correct. But I think the fact is that there's still a lot of opportunity, other zones that can be profitable, longer reach wells, new completion techniques. All of that will make a difference going forward. So will the U.S. be able to raise, let's say I mentioned the number 13.8 million. Will they get to 15 or 16 million barrels a day in $100 oil environment? Probably. If we are at a $70 price environment, it's going to be hard to keep that number where we are today.
Looking at the oil and gas landscape through the lens of an investor now, where are you seeing the most opportunity? And are there any areas of the market that you'd be avoiding right now?
Well, I think anything in the Middle East is something to be avoided. Anything in a war zone you want to stay away from. I think you want to go where there's opportunity. So if the UK opens up the North Sea, then I'd be looking at opportunities in the UK North Sea because their basin, is similar to the Norwegian one, and they're going to find stuff. So whoever is involved there, you want to be involved with. Canada's an attractive place. We're the fourth largest producer in the world. And so we have a lot of opportunities, both with oil sands, conventional oil, natural gas for LNG on the West Coast. The United States, even though some parts of the basin are tired, there's still a lot of opportunity there. And if the prices go up, as I said, I think I expect $90 next year for the average price, but it could be 100, 110, 120 into the end of the decade. The market's never going to pay for $120 oil at the high. When we got to 147 in 2008, the market was prepared to pay for $90 a barrel. Right now, the market's not even prepared to pay for $70 a barrel. Many companies are trading out there at under 3 times cash flow on depressed cash flow. Because of the oil was good in Q2, it's up now, but remember we were $66 not long ago. And so if the company's using $70 oil, that's not great. And the natural gas price, NYMEX is not great. And in Canada, AECO is not great. So these are depressed natural gas prices. At market peaks, like we were in 2008 and 2014, you get trading at 7-8 times peak cash flow multiples. So that gives you how the industry can give you 5 and 10 baggers. If we go back to April of 2025, we put out an action alert buy signal and said that the markets were cheap. We got all of our buy signals in place. Stocks were very cheap. And we said buy, and the price of oil was down, below 60. And the TSX Energy Index went up 110%. And many of the stocks that we cover went up 2 and 3 times from that low. I believe we will see another low coming in the weeks or months ahead if the peace drums start again and people get back to the table and we've come back from this war premium. We may not dissipate all of it, but we may dissipate some of it. And we've been telling people to be at an 80% of your target energy weighting. We're saying that if we get this next buy signal coming, you want to go to 100% of your target weighting. Remember, the S&P and the TSX energy weighting is very small. But if you look at what it was in 2008 and 2014, it was very high. It's not like what happened to the semis where they've taken off and AI have done it. We're never going to see that kind of thing going on. But if you pull out the ratio of where energy weighting was in 08 and 14, much, much higher than it is today, that's going to be the upside for people. And if you find companies where fabulous balance sheets, lots of drilling inventory, management that's been successful in the past, management that has their own financial stake at, their own financial net worth on the line. Those are the kinds of companies you want to own. And we think there's a lot of opportunity down in the U.S. basin, which I don't cover the names, but and I do cover the names in Canada. And I think the Canadian names are cheaper than the U.S. And there's a reason we were cheap. Our previous government was anti-energy. Our new government is pro-energy. And again, that's hopefully what's going to happen in the UK, where the new prime minister is going to reverse totally the anti-energy. They'd rather bring oil in from Saudi Arabia. They'd rather bring in imported LNG. They want to have deficits that they can't afford social services. You got to grow the pie. And our Prime Minister Carney's finally realized that we are not an industrial country, like Ontario and Quebec has industry, but the reality is we are a resource economy, just like Australia, just like other countries. And it's our forest products, it's our grains, it's our precious metals and base metals, and most importantly, it's energy. And you've got to build a bigger pie if you want to spend more money. And as your population becomes older, you need more money for social services and pensions. And so you need a bigger pie to afford that. I think the rationale of that hopefully wakes up, in England, just like it's done in Canada with the new PM.
And so the political winds in Canada, you feel they're currently moving in favor of the oil and gas industry, because you're right. The last administration was much more anti-fossil fuels, anti-hydrocarbons. It seems like this administration has kind of walked that fine line between paying lip service to green energy and the energy transition, but also taking actions that indicate that they are indeed moving forward with positive policy for the energy space. Is that how you see things?
Yeah, I think as I mentioned, they realize that the economics of Canada, especially with the trade battle with the U.S. right now, Trump talking about 50% tariffs on a number of products because of the dairy issue and other things. So and autos, etc. So the tariff war looks like it's coming back. 12 countries are in the bullseye for President Trump's new tariff policies. So I think that. The Canadian government woke up to the fact that, we need to grow our economy, grow our wealth. And that means, access to Europe, access to Asia, access to the States. Enbridge is planning expansions into the States. Southwell is working with a company to bring oil down to the U.S. There's lots of projects on the LNG side on the west coast of Canada, and mining projects and stuff like that. So I think that the bigger the pie is going to provide a massive upside for the whole resource sector. So I'm not I'm a uranium bull, and I own personally some uranium stocks, but I think grain, uranium, forest products, that whole gambit is going to prove to be rewarding for investors. I focus mainly on the energy side, and I think Canadian natural gas, Canadian oil, Canadian companies working overseas internationally using the most recent technologies, and the Canadian energy service sector, I think are all great areas to invest in, and that's what I'm doing. And we cover 35 companies, and what we do is something different because it's for mostly we put it together for individual investors and family offices, our research product. But we also have annually a Catch the Energy conference here in Calgary on October 17th at Mount Royal University, and we have 45 companies coming. So people not only have the research coverage, but they can get face-to-face time with the companies. And for individual investors, that's something that normally does not happen. They might look at a presentation on the website, they might listen to a webcast, but having the ability to look the CEO in the eye, ask him the questions that are on your mind, that's something that we've done, which has created a very successful product for us and why we've had such support in growing our business.
Well, that's a perfect segue into discussing the Schachter Energy Report and your upcoming conference. Why don't you give us more details there, where people can get tickets to the conference and when it's going to be and all that good stuff?
Yeah, the conference is on Saturday, October 17th at Mount Royal University in Calgary. It's a good time to come then because you can always go up to Banff. And if you're a skier, you might should be snow up there by then. Your golf season is over by then, usually. And what we do is we put on a conference where I start the day off with a macro presentation of where we are with a lot of charts of how we see the cycle. And I think we're in an energy commodity super cycle. And there's only two others that I've had in my career, 74 to 81, where Japan became the new entrant. We had wars. We had the price of oil go from sub 3 to 36. And the index went up 15 times and the price of oil 12 times. Not, the other one was 99 to oh 08. China became the buyer of a lot of oil as they allowed capitalism under communism. Price of oil went from $10 to 147. And I think this cycle started with the lows during COVID, and I think it's going to last, in 2-3 years into the next decade. So there's still lots of running room for the golfers out there. I'd say we're on the fifth hole of the golf course. Lots of golf ahead of us, and I think multiples will grow up. So what we try to do is have the biggest companies to the smallest. So the biggest company we have is Tourmaline coming. There's 640,000 BOEs a day. And we have small companies that could be as little as 2,000 BOEs a day. So we try to have a nice mix of companies. And we break our coverage down into three groups: conservative, growth, and entrepreneurial. Conservative are your biggest companies, very strong balance sheets, big production, dividend yields in all cases. So people who need dividend income, that's for them. In the growth side, some pay dividends, but mostly it's the growth engine there. They want to grow 5 to 10% a year in terms of production. And then lastly, the entrepreneurial is the companies where the drill bit matters, the lie detector of the drill bit. If you're successful with the drill bit, you're going to have home runs on the stock. So we try to cover everything for the different risk groups that are out there. I own names in all three categories, but the biggest portion of our investments are in the conservative side because we want dividend income as well as growth. And so it's a great way to come and have face time. with managements. We have presentations of 30 minutes, and then we have booth time. So the companies are at their booths for lengthy periods of time. And then we put on, food the whole day, breakfast through lunch, through, snacks in the afternoon. And at the end of it, we have a panel discussion where there's a glass of wine and you have some very knowledgeable people talking about the strategic opportunities in the energy sector globally, and also, particularly to narrow it down to Canada. So it's a great way to come to learn about the Canadian energy industry, also energy in general on a global basis. And we have support from the TMX and EPAC and Roth Canada, or Roth as sponsors. So we really have a very good support system. And last year we had just under 700 people attending. This year we're expecting 900 to come. How to get tickets? If you become a subscriber, you get 2 complimentary tickets. So just go to our website and sign up for that. There's also a discount, with this podcast. So again, I think it's POD 100 when you do the checkout in the box there for the promo code, and you get $100 off. Remember, it's Canadian dollars, so 71 cents American. So another deal there. Thank you, the government of Canada. And then you get 2 complimentary tickets, and then you'll get the full product, both the Ion Energy, which is our macro product, as well as the SCR, which is our coverage of those 35 companies. So hope to see you there. If you do decide to come and become a subscriber and come up to Calgary, please come by the booth. I'll be at the booth with my team, and you can get to meet the people there. And then, of course, I do the song and dance at the opening for 45 minutes until my wife drags me off. And people usually like it. They want me to stay longer because they want me to answer more questions. But the reality is I'll be at the booth to answer questions so the companies have time to tell their stories.
Great. Well, I'll put a link to the Schachter Energy Report so people can sign up for that. Use the code BOE100, you said?
POD, podcast, POD 100. And put that in the promo code box, and that'll knock off 100 from the Canadian price of $9.99 to $8.99, and then of course times that 0.71 when on your credit card, if you're buying in the States or internationally, with the Canadian dollar where it is, and we'd love to have become part of our subscriber group. And I think you'll find not only the macro product very helpful, but if we recommend ideas in terms of topical areas to invest in Canada, you might find those same topical areas in the US or in Europe or wherever you are. So there's a benefit that the idea generation we have, you can then take to your home location and say, okay, maybe I'll buy a few Canadian names because of TMX, or you have OTC. Most Canadian companies trade over the counter in the States, but you also then have the ability to say, okay, I like that theme. Can I find a name in the States or in Europe or wherever, Asia, that has that same topical story? And then that could be something that would help you as well.
Great. Link will be in the description below. Joseph, as always, thank you so much for coming on the show. Great insights.
Thank you, Jesse. Glad to be with you, and look forward to the next time.
Thank you for joining us today. This episode is brought to you by ARC Silver Gold, Osmium. They have some great prices on precious metals, bullion products. You can see some of them on your screen right now. Reach out to owner Ian Everard today to take advantage, as these are well supplies last and subject to change. The number is 307-264-9441, or reach out via email at ian@arcsgo.com. Make sure to tell him that Commodity Culture sent you, and you have less than 30 days to access the Commodity Culture Boot Camp recording, a 2-hour deep dive into my own portfolio and the lens through which I view the commodity space, and how I beat the S&P 500 by over 4% on a time-weighted returns basis per annum over the course of a 6-year period. The link is in the description, join.jesseday.ca, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.